Welcome to the Deep Dive, where we cut through the noise of quarterly reporting to extract the core strategic insights you need to be well-informed. Today, we are digging into Guidewire ticker GWRE and their fiscal Q1 2026 financials. And this wasn't just another quarter, it was a record sales period. And I think more importantly, it signals a really clear strategic shift for them.
It really does. They're a core system provider for the property and casualty, or P&C, insurance world.
And our mission here is to find those aha moments. How is this maturing cloud platform turning into completely new ways to make money? We're looking at generative AI, new products, all based on the call with CEO Mike Rosen and CFO Jeff Cooper.
Right. So let's just start with the top line summary, because this was, frankly, a clean sweep. Guidewire just delivered a comprehensive beat across every key metric. It really set a confident tone.
Okay, so give us the highlights.
First up, annual recurring revenue, ARR. It ended the quarter at $1.063 billion.
$1 billion in ARR.
Over $1 billion. And that's 21% growth year over year on a constant currency basis, which is, comfortably ahead of what everyone was expecting.
Okay.
Total revenue also came in really strong, $333 million. That's a 27% jump from last year.
So strong performance everywhere.
Exactly. And then there's profitability. This is where you see the leverage kicking in. Non-GAAP operating income surged to $63 million. That's an 83% increase.
Wow, 83%. And what about the balance sheet? They're investing a lot in AI, so they need the cash.
Oh, it's fortress-like.
Yeah.
Totally crucial for what they're doing. They ended the quarter with over $1.4 billion in cash equivalents, and investments. So. Yeah. Plenty of liquidity.
Okay, so those headline numbers, they're excellent. But the real story in enterprise software is always in the mix, in the details. For years, the Guidewire narrative has just been this long, hard cloud transition. What does the revenue breakdown tell us about where they actually are in that journey right now?
It tells us the engine is, it's fully online now. Subscription and support revenue, that's the purest measure of their cloud success. It grew 31% year over year to $222 million.
That's strong, consistent growth.
It is. But what's fascinating, and you picked up on this, is the license revenue.
Yeah.
You and we usually expect this legacy piece to just shrink as customers move to the cloud.
It should be going down, yeah.
But it actually grew. It was up 12% to $42 million.
Okay, that definitely raises an eyebrow. Now, management said this was just timing, right? Something about a big annual term license renewal hitting the books from an old deal.
That was the official line.
But I have to ask, Is that timing really organic? Or is there a risk they're just, managing these legacy renewals to juice the numbers a bit before the cloud shift finishes?
It's a fair challenge. But based on their commentary, it really does seem to be just a function of accounting cycles. These old-term contracts, they recognize revenue up front. So you get this vacuum until the multi-year term ends, and if the customer renews for just one more year before making the big jump, you see this little blip.
So you don't see it as a red flag?
No, because the fact that subscription revenue growth is so robust, 31%, that tells you the strategic curve is still steep and moving in the right direction. I think this license revenue spike is just noise, not a signal about the future.
Good clarification. So let's talk momentum. You said it was a record Q1 for sales. Who are they winning? And maybe more importantly, what are these new customers buying?
Well, Q1 saw 8 new cloud deals globally. That's a massive number for a first quarter. And the reach is impressive. 5 in North America, with big names like the Hartford and SMO.
And international.
3 big international wins. A respected UK mutual, a major migration in Japan, and a large Australian insurer. It really confirms they are still the dominant global player in this space.
But it's not just who they're winning, right? It's what they're attaching to those deals.
You hit the crucial point. 6 of those 8 new customers immediately included one or more of Guidewire's data and analytics offerings. So they're not just buying the core system replacement. They are buying into the whole ecosystem from day one.
Which means higher dollar deals and a stickier platform right out of the gate.
Exactly. That attachment rate is a huge signal for future monetization.
So let's pivot a bit to the operations, the cost side of things. We saw that strong subscription gross margin, what was it, 73%?
Yeah, 73%, tracking ahead of expectations.
But management also flagged some pressure on professional services margins, even though that segment brought in a healthy $68 million.
Yeah.
Why would they accept lower services margins right now?
Because it's a deliberate strategic choice. They're prioritizing long-term market share over short-term efficiency. They are, and they said this very clearly, aggressively increasing investment in services capacity. They're using more subcontractors, and they're pouring money into their AI initiatives.
So this is non-negotiable for them.
Completely. They see it as necessary to make sure these huge, complex cloud programs succeed. And critically, it enables the rapid uptake of the new products we're about to talk about. If they can't deploy customers successfully, the whole strategy just stalls.
Okay, investing in capacity makes sense with record sales, but relying heavily on subcontractors, that's a common risk, isn't it? I mean, especially with mission-critical migrations. Quality control can become an issue.
Oh, that risk is absolutely there.
Yeah.
And that's why they emphasize this balance between their own people and external partners. The scale of these migrations for top-tier insurers is just massive. They can't staff it all internally fast enough.
So it's a calculated risk.
It's the bet they're making. They believe their established processes and certifications will maintain quality, allowing them to scale deployment without sacrificing the outcome. It's a necessary evil when you're growing this quickly, but it's one you, as a listener, should definitely keep an eye on.
Right. And here is where the narrative really shifts. The CEO, Mike Rosen, he framed Q1 as them being confidently through the most difficult part of our cloud journey. That platform maturity, that's the key. What new doors does that open for them?
The core message is crystal clear. The Guidewire platform is finally mature enough that it aligns perfectly with the arrival of generative AI. They are pivoting. They're going from being a system of record company to a high-value workflow applications company.
Going wider and deeper.
Wider and deeper. They announced 2 major new applications. They're calling them centers of value.
Okay, what are they?
The first is the pricing center. This is specifically for actuaries. You know, in P&C, there's often this huge lag between when an actuary knows a price needs to change and when that change is actually live in the system.
The rate filing and implementation process, yeah, it can take months.
Exactly. This pricing center aims to let them bring complex models to market much faster, with more precision. It collapses that long manual lag time that costs insurers millions.
And the second one?
The second is the Underwriting Center. This is all about improving risk selection, streamlining operations, accelerating, quote, times. Underwriting is often so fragmented today, right? Data from everywhere, manual processes. This is meant to be a unified, data-driven workbench to fix that.
And these aren't just add-ons. You said they are AI first. They use the term agentic AI. For listeners who might know basic Gen AI, what does agentic AI actually mean in this context?
It's a critical distinction. Think of traditional Gen AI as a tool that finds and summarizes information for you. It answers a question.
Like a chatbot.
Right. Agentic AI goes a step further. It is designed to take action, to complete multi-step tasks within the application. It's an intelligent assistant that doesn't just find the policy language for you. It analyzes the claim, figures out the next steps, automatically routes documents, and even pre-fills forms based on the context.
So it's acting like a junior underwriter or a claims adjuster itself.
Precisely. It initiates parts of the workflow, speeding up the whole process without needing a human to click every button.
That is a massive change in the value proposition. And I guess the recent acquisition of Pro Navigator fits right into this.
It fits perfectly. They highlighted Pro Navigator, which they found through their own InsurTech Vanguard program, as key to delivering this agentic experience. Pro Navigator is essentially an AI-powered knowledge base that's been specifically trained on the incredibly complex documentation of the insurance industry.
Policy wordings, regulatory manuals, all that stuff.
All of it. So by plugging Pro Navigator in, they can deliver instant context-aware answers right inside the workflow. It solves a huge pain point for carriers.
And when the analysts on the call pressed them about how long it will take for customers to adopt these new centers, what was the response? Because this sounds like another big project.
That's the really clever part of the strategy. Management suggested adoption might actually be faster than the core system migrations.
Faster.
Because they can be positioned incrementally. Unlike replacing your entire policy center, which is this all-or-nothing replacement of a system of record, these centers can be attached to existing cloud customers. They plug into the suite and start delivering value almost immediately, which makes the ROI so much easier to justify.
Okay, let's talk competition. Everyone is rushing into Gen AI. Management stressed this open platform philosophy, saying they want to foster innovation, not constrain customers.
Yeah, and this is a really crucial strategic debate. The open platform approach means they're basically inviting third parties, insurtechs, even the big hyperscalers like Microsoft or Google, to build powerful AI tools on top of Guidewire.
The benefit being they become the center of the ecosystem.
Exactly, which is immensely sticky.
Right.
But the risk of an open platform is margin erosion. If you're not the one providing that proprietary AI at the top of the stack, you could lose that high-value margin to someone else.
So they're betting that being the indispensable core system is enough.
They're betting that the value of being open outweighs the risk of sharing the Gen AI revenue pie, and that replacing the core system is just too hard for rivals to do.
So let's bring it all together. Strong beat, the cloud transition is stable, and now this major pivot to AI workflow. What does all this confidence mean for the rest of the year? I mean, raising guidance after Q1 is a big deal.
It's unusual, and it tells you a lot. It's driven by that strong Q1, their confidence in the pipeline, and, of course, the little bit of revenue added from the Pro Navigator acquisition, about $4 million in ARR.
So what are the new numbers?
They lifted full-year ARR guidance to between $1.22 and $1.23 billion. And importantly, non-GAAP operating income also got a lift to between $266 and $282 million.
And that's after absorbing the costs of the acquisition and all that services investment?
Exactly. That's a very strong operational signal. They're investing heavily and still raising the profit outlook.
So the story now is that growth is coming from everywhere. Cloud migrations, new customers, and now this long-term potential from the new products.
That's it. And the most compelling long-term signal that Mike Rosen really stressed was how their biggest customers are behaving. These large migrations now involve moving their complete landscape, everything they run.
Not just one piece.
Not just one piece, the whole suite. That shows Guidewire is earning this deep, multi-decade trust. And they see Gen AI as a tailwind, not a threat, because carriers know they have to get on a modern platform like Guidewire's to even have a chance at leveraging AI at scale.
Okay, it's time for our This Is Not Financial Advice segment. So we've just heard about a company pivoting. They're moving from a successful but kind of slow cloud migration story into what they hope is a really fast, high-value, AI-powered application story. That's a fundamental change.
It is. And the market, the street is still largely treating Guidewire like a compounder that's tied to that slow migration cycle. It's valuing the company based on that predictable transfer of revenue from license to subscription.
Which is safe, but maybe too slow if this new strategy actually works.
Exactly. The real surprise, the real potential upside, lies in the immediate uptake of that new pricing center and underwriting center. If management is right that these things deploy faster and attach quickly, the whole valuation framework for the company has to change.
So if we believe in that rapid attachment, what's the outrageous but plausible trade idea to capitalize on that shift over the next, say, 12 to 18 months?
We're proposing a synthetic long strategy on GWRE. Now, for listeners, a synthetic long just tries to replicate the profit and loss of owning the stock, but it uses options contracts to do it. It's a way to get leveraged upside with defined risk.
Okay, so how do you build it?
Specifically, you'd simultaneously sell put options a little bit below the current stock price, and then use that money to buy a bullish call spread that expires 12 to 18 months from now.
Okay, let's break that down. Why sell the puts?
Selling put options gets you cash premium today. You're basically getting paid to agree to buy the stock at a lower price. This lets you harvest the fear premium that's always there with any enterprise software company that's investing heavily. It gives you cash flow and lowers your cost.
And then the bullish call spread.
That part gives you the big upside. You buy a call option at one price and sell another one at a higher price. It limits how much you have to spend upfront, but gives you significant leverage if the stock really moves up, because these new AI centers are a huge hit.
So the underlying thesis here is very clear. If these new centers get, let's say, a 20% attachment rate with their existing customers in the next 2 years, the company will have earned a huge multiple re-rating.
It'll move from a slow migration multiple to a dynamic AI workflow monetization multiple.
And this synthetic long trade is designed to capture that potential re-rating with a lot of leverage while hedging your entry costs.
Precisely. It's a bet on rapid execution of the new AI strategy, completely overriding the old, slow-moving cloud story.
So a really strong opening quarter for Guidewire. It marks a stabilization in the core cloud business and a very clear pivot towards new, high-margin, Gen AI-powered growth.
The whole story has shifted now. The technical part of the cloud migration is mostly behind them. The questions now are, can they execute on these new centers of value fast enough to change the market's perception? And how will their open platform strategy hold up against competitors who might offer a proprietary, all-in-one AI stack?
That execution is the narrative to watch.
It's what you have to watch closely over the next few quarters.
We hope this deep dive gave you the specific nuggets of knowledge you need to be well-informed and maybe a little ahead of the curve. Join us next time for more insights from the earnings call circuit.